Well, it's that time of year again when Americans begin to prepare and file taxes. But now, due to Obamacare, there are specific changes that you need to be aware of when it comes to your taxes. Here to break it down for us is certified financial planner Jerry Lynch. Jerry, thanks for getting up with us this morning.
Thanks for having me.
Taxes are the worst time of year for everybody all the time, but it's getting a little bit more difficult now because there's a bunch of new regulations.
Well, I mean, I don't think anybody really plans for their tax returns. And then what happens is in April, or in February, they bring their CPA shoebox worth of receipts. If they get a refund, they think they won. And if they have to write a check, they yell at their CPA. There really is no proactive part of the planning process. So I think the most important thing that people could do is talk to their CPA during the tax year so they actually can have an impact on their taxes for the next year.
That's great advice. Let's talk about a couple of the things that are changing this year. So for married couples earning $250,000 and individuals earning $200,000, there's a new Medicare tax.
There's a tax on earned income, which is 0.9% above $200,000 for a single, $250,000 for a family. So it's not on the entire amount of income that you have, only on those incremental amounts. There's really not much you could do on that. Again, it's earned income, it's income that you're getting from work, so it is what it is. On the investment income, there's a 3.8% surcharge, which is on interest that you get from your bank account, capital gains, dividend income, anything that is considered investment-related income. That you have a lot of control over.
How so?
Well, I mean, for example, instead of being in taxable interest, I could be in municipal bonds. Municipal bonds are exempt from some of these surcharges. If I have a capital gain and I have to sell out of a security, what I could do is I could sell something that has a loss so that I offset that gain. The other thing I could do is if I'm thinking about getting married, I can marry somebody who's got a loss carry forward to offset some of the gains that I have, which is a great tax planning strategy, but it may not be a good one.
And it's also a brand new dating strategy.
It is.
All right, so there's the next one is unreimbursed medical expenses for those under 65.
For the most part, you're not going to get a deduction on your medical. You have to exceed 10% of your income to be able to deduct your medical expenses. So if for some reason you're getting relatively close to that, one of the things that we suggest to people is that you bunch your deduction so every other year you try to hit it. So if I think this year I'm going to hit my threshold, what I want to do is I want to go for as much medical as I can. I want to do my dental. I want to get my eyeglasses. I want to bunch as many deductions as possible. So if I'm exceeding that threshold, I have the ability to write it off.
But do I understand that now under Obamacare that those thresholds have gone up?
It has. It went from 7.5 to 10%. So in general, you're not getting a deduction.
Okay. Now, in 2015, there are also going to be some changes. For the people who did not get enrolled in Obamacare, there are fines coming.
It's not that big. I mean, again, it's $95 for single, and I think it's $238 for a family. It's not, I think if you're going to have a penalty for somebody, have such a penalty that it's going to say, I really got to change this.
Yeah, but isn't that coming in 2016, isn't it? The penalty the first year is low, but it really ramps up.
Again, it does ramp up, but it's still, I mean, if somebody's young and healthy, it's still not as much of an incentive for them to go out and buy an insurance policy than paying the penalty. And the problem is if those people aren't getting into the medical system, the other people are higher users. You're going to have what's known as adverse selection going through the system, and it's not going to be good.
Okay, now, and is there any penalty for people who actually do buy it?
There's not a penalty. You actually get depending on your income, you may qualify for a tax credit. And a tax credit really is a dollar-for-dollar deduction off your tax liability, versus a tax deduction, which is only a percentage. So to give you an example, if I get a $1,000 tax credit, it reduces my tax liability by $1,000. If I get a $1,000 tax deduction and I'm in a 25% tax bracket, I only get $250 back. So the tax credits are actually pretty nice.
Yeah,
very nice.
Except that then that tax credit gets passed on to somebody else who's picking up that part.
Pretty much.
Which is
somebody's always picking up the tab.
Exactly. All right, Jerry Lynch, thank you much for all this information.